Welcome to this lesson on understanding the balanced scorecard, and gain an insight into one of the most influential strategic management tools of the past 30 years. Introduced in 1992 by Harvard Business School Professor Robert Kaplan and David Norton, a management consulting firm head, the balanced scorecard system recognizes that financial performance is just one part of the larger picture of organizational performance. The system seeks to balance a company's financial objectives and targets with three non-financial perspectives of performance, including the customer and market, internal processes, and workforce learning and development. Here is an example of an extract from the financial perspective of a scorecard from a coal mining company. We can see that for each strategic goal, the company has identified one or more objectives and associated performance measures. Thus, for the objective of achieving a return on assets of 10.8%, the objective of optimization of production activity will be measured by total production cost per ton of coal produced. And here is an example of an extract from the customer and market perspective of a scorecard. And here is an example of an extract from the internal process perspective of a scorecard. Here we can see that 6 metrics will be used to measure production operations. Oftentimes, the internal process perspective will include many more measures, which will reflect the nature of the organization. And finally, here is an example of an extract from the learning and growth perspective of a scorecard. Notice the range of measures, from training and development, to employee turnover and absenteeism, to lost time injuries. These are typically important people management metrics for a mining company. Here is an example extract from a balanced scorecard. As with many scorecards, this example details the results over 2 months. The colors represent the results scored against target. Red indicating below target. Yellow, marginally below target, and green indicating results above target. There are numerous variations on the balanced scorecard which reflect the specific context of differing organizations. Here is an example of a strategy map from a scorecard for a military hospital. Note the differences in perspectives from the standard template. A key feature of balanced scorecard methodology is a strategy map. A strategy map is a one-page document. A strategy map graphically depicts the executive's understanding of the organization's strategy and the cause and effect relationships among the 4 scorecard perspectives. It shows the strategic objectives of each perspective and how they will affect performance on objectives in other perspectives. Many companies develop a corporate-level strategy map, as well as strategy maps for each division, unit, and department. These lower-level maps contain objectives supporting the higher-level map. Here is an example of a strategy map for a utilities company. Note that the top-level perspective in this scorecard is not financial, it is the customer, and the focus is on driving customer satisfaction. A key feature in the design of a balanced scorecard is the identification of causal linkages between objectives across a scorecard. When an objective is identified at one level, we look for the drivers of performance which will enable us to achieve the objective. So, in the scorecard example here, we can see that in order to improve customer management processes, we need to improve CRM skills and knowledge. The strategy map is then a performance driver tree, superimposed on a template with 4 perspectives. In this way, the strategy map displays all the key drivers of business performance on a single page. Many people inside and outside a company use performance measurement data. Executives use the data to review how well corporate strategy is being implemented, and whether major corrective actions need to be taken. Unit managers and group leaders use performance data to motivate and evaluate employee performance and productivity. Shareholders, industry analysts, customers, media, and government regulators use data to make choices such as whether to invest in or buy from a company, or to determine whether an organization is operating with efficiency and integrity. And employees use performance data to learn whether they and their teams are contributing to company goals. Managers at all levels in an organization can track key performance indicators to assess how well their groups are meeting their business objectives, whether performance is improving or declining, and how their group's performance compares with that of other units or groups within the company and in rival organizations. Consider these examples. A CEO examines return on investment by division, or her company's cash flow, by month and quarter, and compares the results to those of competitors. A customer service manager tracks customer service quality using surveys. If the survey suggests that service quality is dropping, he might need to add more account representatives to improve service levels. In another such example, a product development manager assesses the ratio of sales from new products to total sales. He decides that his group needs to invest more in research and development to increase the ratio. A human resources staffer calculates the percentage of employees who actually attend voluntary training programs offered by the company and compares the result against the targeted percentage. A drop may indicate the program is unsuccessful and can prompt an inquiry to find out why, possibly saving the company thousands of dollars in ineffective training programs. Many companies develop corporate-level scorecards as well as scorecards for each division, unit, and department. These lower-level scorecards contain objectives, supporting the high-level corporate scorecard. The diagram below illustrates a typical architecture for aligned scorecards and performance plans. We can see that each business unit develops balanced scorecards and associated performance plans for each manager. Then, departments develop scorecards for their teams, and each department manager has an associated performance plan. In management information systems, a dashboard is an easy-to-read, often single-page, real-time user interface, showing a graphical presentation of the current status, a snapshot, and historical trends of an organization's key performance indicators to enable instantaneous and informed decisions to be made at a glance. Without effective communication to all your stakeholders, your balanced scorecard system will be worthless. The 6 slides which follow contain some steps to communicate performance data to your group. Let's look briefly at each of these steps. Step 1. Review your group's performance data. Gather all the reports, forms, and other documents in which your group's performance data are recorded for the period in question. Review the data, looking for places where actual performance differs from the targets you set. Step 2. Craft a story about what's happening. Based on what you're seeing in your group's performance data, develop a narrative describing what's happening with performance. Highlight interrelationships between metrics, and note possible explanations for why actual performance is differing from targeted performance. For example, we're having trouble reaching our targeted 3% error rate, and that's negatively affecting customer satisfaction and costs. New hires and order processing software may have played a part in raising the error rate these past 2 months. And seek others' ideas about the underlying causes of performance problems. Peer managers, your boss, and some of your employees may have valuable insights into what's going on. Step 3. Create charts and graphs. Where possible, translate numerical information into simple charts and graphs that capture trends. For example, a line graph showing an increase in error rate over the past 6 months can prove far more compelling than a list of numbers. Also, snapshot views are handy for senior management. Thus, if you will be sharing performance results with them, they will appreciate receiving information in such a succinct way. Step 4. Select the appropriate degree of detail. Consider what your employees need to know about the group's performance in order to make improvements. Too much detail, and your employees may become confused or lose interest. Too little detail, and they may not grasp the importance of a performance problem. Step 5. Communicate difficult facts constructively. Even if your narrative, your charts and graphs, and the details you've gathered about your group's performance present a discouraging picture, it's important to communicate the truth about performance to your employees. However, in communicating the information, strive to do so constructively. That is, don't single out individuals as the cause behind poor group performance. Instead, look for the problematic processes and systems behind the shortfalls, and explore ideas for addressing them constructively. Finally, in Step 6, create opportunities for review and discussion. Set up meetings and review sessions with your group to specifically discuss performance results and changes made to address them. Together, explore what has worked well and what hasn't. Encourage your employees to adopt a mindset of continual, collective improvement. In this lesson, we looked briefly at the subject of balanced scorecards, and specifically at how balanced scorecards are designed and used. Strategy mapping. KPIs and their use, and then finally, at communicating performance information effectively. If you would like to learn more about balanced scorecard design, check out our course on developing a balanced scorecard system. Want to fast-track your career in management? Click on our website to view our range of hundreds of business and management courses and qualifications.